Well, good evening, everybody. It's Richard Bowser here from Property Investor News, and this is the October webinar. So thanks for coming on board, everyone. Yeah, so we're into the we're into our October webinar. We'll be doing another one in a couple of weeks' time, but let's just go through what we're covering tonight, everyone. So I'm going to do a very brief market summary for you shortly. And then we're going to hand over to our main speaker for tonight. It's Manish Kataria, and he's with Invest Like a Pro. Obviously, some of you who are regular readers of Property Investor News will know that Manish is a regular contributor to Property Investor News, talking about a whole variety of subjects really related to financial and investment matters. And he's obviously a professional financial advisor. So let's get on with this presentation. And Life Beyond Lockdown is the title. And yeah, so it's just a quick market summary. For those of you who are not aware of Property Investor News, and we do have some guests on board tonight, we've been publishing this monthly magazine now for over 18 years, and it offers in-depth market analysis. It's not a get-rich-quick magazine. If you're looking for your next £1 million in the next few months, then perhaps it's not a magazine for you. But if you are interested in on an ongoing basis getting in-depth market analysis, then perhaps you might consider subscribing to Property Investor News. Because we've been going now for getting on for 19 years, we've got well over 15,000 articles now embedded in our website, and you can search those at your leisure. We've now got well over 250 searchable video interviews with developers, with portfolio landlords, and with trade sources talking about the marketplace. And this year we've done a lot of webinars. I think this is the 15th or 16th webinar we've done since March, the whole range of topics that we've covered. This is the second one with Manish. The last one that we did with Manish was back, I think, in March. That is like all the others that we've done. It's all these webinars are all recorded and saved in the Property Investor News archive, and subscribers can access all of those webinars and the videos and, of course, all the articles via your subscription password. What do we cover? Well, we cover land development, planning, HMOs, the whole range of topics that you guys want to know about. And when we do investor interviews, there's no fluff. I mean, the one we've just recently done in the October magazine with Claire Norwood, it's one of the most frank and honest interviews that I've done with a property developer. And her and her business partners, they really gave me some great information. I know that many of you on this call tonight, on this webinar, will have read that article. Really appreciate the honesty and the transparency that I got from Claire and Joe and Dan in that interview, talking about the challenges of property development in the current marketplace. So yeah, we've got more upcoming, but some really good interviews upcoming in the next few months. That's the website. Go and have a look at it. Okay, so let's just quickly just talk about where the market is at currently. And sorry about that. So this is Home Track. As some of you who watched previous webinars with me, you'll know that Home Track is one of my favored sources of information to get residential property market analysis. So this was the picture at the end of August, so not that long ago. I think the latest Home Track data will be out in the next week or so, but this was the end of August data. What does it show us? Well, obviously, as we know, the market was very strong once lockdown occurred from June, July into August, into September. And I'm going to point out a little bit more data to you in a minute, but this was the regional picture. So on the left-hand side, you've got the top 20 cities by population size. We've got the average property value as of today, or as of at the end of August. Those are the average values. So in Aberdeen, 144,600 was the average value. And then we've got the performance over various periods. And on the far right, we have the bar chart showing monthly performance from left to right over the previous 12 months. So the figures on the right are the most recent month's performance. So you'll see a whole mix of locations showing different performance. Some of this may not come as any great surprise to you, but clearly Aberdeen not performing well at all for quite some time. A location like Oxford, for example, where my main home is, out in Oxfordshire, a bit of a tick up there from Oxford, started the year quite poorly. And then demand has picked up, still not particularly strong, as you can see from the data. But of course, Oxford, along with Cambridge, London and Bristol, being one of the strongest performers over recent years in terms of average house value increases. And if you look at the second column, you'll see that Oxford had seen a 45% increase in prices since the middle of 2007. That was the previous peak, and 73% from the trough in 2009. In terms of the regionality, you can see there that the Midlands areas and the North Midlands and up into South Yorkshire, Sheffield, very strong performance. Leeds again, the Northwest, which is forecast to be the strongest region going forward over the next 3, 4, 5 years. That place like Manchester obviously showing strong performance. So that's the home track data, and this is very recent data. We only got in on Friday of last week, and it comes from home. And this is, I always find this interesting to show the trends in terms of time on market. So effectively, these are the strongest, the hottest locations in the country, including Scotland and Wales. These are the strongest markets. So if you're a property developer, these are the markets where you would want to be selling stock. At the moment, Glasgow and Edinburgh, which is number 8. So from left to right, these are the top 20 locations. So we can see that Glasgow, the strongest market at the moment in terms of time on market. That's the amount of time that a property sits in a virtual estate agent's window. So a real mix there. But what is interesting, of course, those that have been mentioning about the London market that's not being too well, you're going to see some real contrast in these figures here. Because Walthamstow in East London is number 4, and we've got Clapham in there as well, and Balham down in South London. So all this talk about the London market being in free fall, or has been, you know, it's very much, you know, you've got to look at the detail, and it's you know, it's not a one size fits all. There are 32 boroughs in London, including the city. So I think it is. So there we are. And then, so you know, we've got a real range here. We've got Bristol, we've got Coventry in the Midlands, been quite a strong market for a while now. We've got York, again a strong market, a lot of equity in some of those locations. Bristol still in there. So these are the locations where the market is the strongest and where you would want to be selling property. Of course, you would not want to be selling property in the worst performing markets unless you'd bought very, very cheaply. Aberdeen sadly continues to be the laggard in terms of the national picture. It takes now almost 400 days typically to shift a property there. But look at the contrast with central London, Mayfair and Knightsbridge now almost 400 days to sell a property on average. Many of these locations, as you can see, in terms of the worst performing markets, are in and around central London. And then we've got a few others in there, South Shields up in the northeast, but virtually all of them, in fact, North and South Shields to the worst performing markets. So there we are. That's the national picture in terms of time on market, and I hope you find that interesting. So I'm now going to, so that's me, take some notes if you're not aware of who I am. Right, okay, so with any luck, we've got our main presenter tonight. Manish, are you there?
Hi, can you hear me, Richard?
Yeah, I can hear you loud and clear. Thank you, Manish.
Great, okay, thank you very much, Richard. Good evening, everyone. And yeah, just say thank you to Richard for having me on again. This evening, I'm going to be talking predominantly about macro and markets. what's been happening to the world, the global economy, the UK economy, global markets, focusing mainly on stock markets and property. So where we've been, where we are now, and probably more importantly for most of you on here, where are we going from here, and how does that translate into your investment strategy? What do you do now? The chances are most of you are investors on here. You're interested in property, you're interested in stocks, hopefully, and you have some capital that you want to deploy. And from experience, most investors I talk to and I hear about have got too much capital sitting around not doing anything, and most people are fearful, and for good reasons. They're fearful about what's going to happen. So hopefully this presentation will address some of those concerns, and hopefully we have lots of questions at the end. So I will kick off there. And so what we're going to cover is what I've just said, macro and markets. I've also just had an article published in the October issue of Property Investor News. So we're going to just start off covering that off. There's been a lot of interest on the article, and it's about Ray Dalio and Warren Buffett, and it surprised a lot of people to see their performance numbers, and their performance numbers haven't been that great. Certainly over the last 2 years, they've been pretty bad. Most people have been shocked about how bad they've been. But even over the last 10 years, there's been a lot of underperformance there. So I'm going to talk you through, why that's happened and some of the numbers behind that performance. And then we sort of move on to the main part, which is really about market performance. What's happened since COVID? What did COVID do? And how did the markets react? And what's happened since then? So as I said, we're going to drill down into stock markets and property, and what is behind the strength that we have been seeing. The outlook, what are the key drivers behind the outlook, 12 months down the line? What are we going to see? I should say at this stage that look, I'm not in the prediction game. I don't like making predictions. I occasionally comment on what's happening to the markets and where we're likely to be, but I'm not going to offer any investment recommendations here tonight. I'll talk about how I see the markets and how I'm positioned, but please don't take any of this as investment advice. And always remember that your capital is at risk, and past performance is no guide to the future. Okay, and we will talk about investor strategy. What am I doing right now? What can people do? What are the options that people can consider? Again, this is not personalized investment strategy. This is general investment strategy. What are the options open to any investor at any point in time? Okay, so that's what we're going to cover. A bit of background for people who have never come across myself before. Who am I? So my background is in corporate banking, investment banking. I used to be a full-time investment manager. These are the names I used to work for. I used to run money professionally for JP Morgan, Insight Investment, Russell Investments. I'm still involved in the city doing investment management, but on a part-time basis nowadays, not on a full-time basis. At the same time, I've always been interested in property. I've been involved in property. So here are some of the things I've done. I've done some property development projects. Some images on the left. I own a portfolio of HMOs and buy-to-lets, and between the two, my corporate background, where I cut my teeth on due diligence, risk management, diversification, that sort of thing, combining that with property, that led me to form Invest Like a Pro. Now, Invest Like a Pro is it's an investor circle. We do the due diligence on investment opportunities, and we circulate those to investors who are interested. So let's kick off on the article. So a couple of performance numbers I want to highlight. So this is for 2019 and 2020. We're comparing the performance numbers for Ray Dalio, which is the red chart, the red bars. Warren Buffett, this is his investment vehicle, the orange bars, and the S&P 500 index, which is the US index. Okay, so 2019, and this was in the article which I talked around. In 2019, Ray Dalio was pretty much flat. He was up a tiny bit. Berkshire Hathaway, Warren Buffett was up 7-8%, and the S&P was up close to 20. Okay, so pretty big underperformance by both of those. They still made money, but very, very, very low, underperformance compared to the index. 2020, it got even worse. Okay, so as we speak right now, the S&P is up around 5% year to date. Ray Dalio's had a pretty shocking year so far. This is up until the end of August. He's down almost 20%. This is for his pure alpha fund. Okay, this is the biggest fund. This is really the profit generator for Bridgewater, which is Dalio's fund, Dalio's firm. Okay, so this is why this fund is probably the most relevant, I would say. Buffett is down 3 or 4% year to date as we speak, and the S&P is up. Okay, so it's up almost 5%. So looking at those 2 years, we've had underperformance and underperformance across the board, and this year it's been, it's been negative absolute performance. So both of them have lost money in a year when the market is up. Okay, so if you translate that into money terms, same data, but just looking at if you had invested $100,000 at the end of 2018, what would have happened? So if you put all that money into Warren Buffett's Berkshire Hathaway, you would have made, I don't know, what's $5,000-$6,000. You would have been up. So yeah, you're up. If you'd put that same amount of money into Ray Dalio's Pure Alpha Fund, you'd be down almost 20%, down 20,000. And all of this during a period of time when if you'd bought a simple, low-cost S&P 500 ETF from Vanguard, you'd be up almost $40,000. Okay, so that's the comparison. Now these are over the last 2 years, but people have asked, okay, well look at the long term. So if you look at the last 10 years, which is shown on this chart over here, this is a comparison of Warren Buffett's investment fund, Berkshire Hathaway, in that's the blue line, and the S&P 500, which is the green line. So over the last 10 years, okay, from here. So you can see they pretty much tracked each other. In fact, the S&P was always ahead by a little bit, and Berkshire Hathaway was always playing catch up. But over the last couple of years, that performance differential has really widened out. So over the last 10 years, in aggregate, there's almost a 50% differential between the S&P and Warren Buffett's investment fund. So that's pretty big. That's pretty big over the last 10 years. Ray Dalio's fund doesn't publish numbers, so it's harder to get the actual numbers. It doesn't actually publicly release those numbers. The only way you can find out about what Ray Dalio's fund is doing is by asking investors. Only investors in the fund get to know how the fund is done. From the research I've carried out, it's not been great. Okay, so it certainly hasn't outperformed the S&P 500. We've got good data from 2012 onwards, and over the last 8 years, there's been an annual differential in performance of 6 or 7% per annum. Okay, in favor of the S&P and away from Ray Dalio's fund. So that's the performance, right? The numbers don't lie, and these are the numbers. I've had a lot of comments from people who've a lot of people have been shocked and surprised that look, they've got an amazing public image. Everybody loves these guys. They're widely revered. People cling on to their words, but they find it hard to imagine that they can underperform like they have. But look, these are the numbers. Okay, not to say I don't like these guys. I think they are legends, and if you read my article, it's very, very complimentary to both of these individuals, because they have their place in history, and they may very well, if history is any guide, they might very well come back and outperform again. But the point I wanted to make is that just because they happen to be gurus doesn't necessarily mean that gurus and personalities can never lose money, okay? And my wider point really in this is to kind of just show to people that, look, investing is really about examining the evidence. It has to be evidence-based, and look at the nuts and bolts, and don't be drawn. It's very easy for investors and people in general to be drawn to image and credibility rather than the nuts and bolts, okay? So that was all really, and this is a chart which I've shown before, kind of just illustrates that point. Okay, so if you look at standard investing theory, you have risk and return. So this chart is just showing that risk and return are linked. Okay, so you have a low risk investment by, this is the investment L. Okay, it has low expected returns. And if you invest in something like a H, you have high risk but high returns. Doesn't mean one is better than the other. It just depends on what your own risk tolerance and your own risk preferences are. Okay, so that's great, but you very occasionally, sorry, not very occasionally, but on a fairly frequent basis, you get investments that look like C. Now, investments that look like C carry high risk, but they give you lower returns. And I spend a lot of time looking at property development projects and investing into other people's development projects. And property developers and promoters are very, very good at, improving their credibility. Social media is very, very easy nowadays for you to kind of deliver perception and make people believe that you are a safe pair of hands. And it's very easy to artificially create a perception of safety. And what that effectively does for those people is lowers their cost of capital. So what I always say to people is, pay less attention to what the credibility, what the public profile of promoters is. Really get your hands dirty and sort of do the, examine the evidence, examine the security, the nuts and bolts of any investment. And then once you make an assessment of how risky that particular investment is, only then can you compare across investments. Okay, so it's much easier to do within property development projects. If you're looking at Ray Dalio's fund, which is pretty much a black box, it's hard to know, it's hard to do the due diligence and de-risk that investment because you don't really know what's inside that fund. Whereas if you're looking at a property development project, it's much easier to do your due diligence, looking at the security, looking at the exit, etc., etc. Okay, so okay. So that we covered Ray Dalio, Warren Buffett, and the whole idea about public image versus performance. So we're going to just move on to, what have markets done post-COVID? Right, here's a chart comparing the S&P 500 index, which is the general market index in the US. That's the blue line. The green line, which is the NASDAQ, which is the technology-heavy index, which has done very, very well, and the black line, which is the FTSE 100 index, which is the UK index. Okay, so you see that huge collapse early March. Okay, clearly related to COVID and the outbreak we saw in February, March, and the subsequent lockdown. Okay, markets fell off a cliff, and I've actually got some numbers here. I don't know why this is not working. Oh, hang on. Okay, here we go. Right, so in number form, markets fell off a cliff from peak to trough, 35%. But since the lows, they've had a really strong bounce back, particularly in the US. So the S&P is 52% off its lows. The tech-heavy NASDAQ is 67% off its lows. And the FTSE, it's had a bounce back, but it's been a real laggard compared to the US indices. And so year to date, who would have thought it? 6 months ago when we were in the eye of the storm, when it felt like the world was collapsing all around us, going back to March time, who would have thought that 6-7 months later, the markets would be posting all-time highs, right? The Nasdaq is at an all-time high. The S&P has been flirting with all-time highs. The FTSE hasn't gone back to all-time highs, but markets are very, very strong. Global equities are really, really strong, and the sentiment is very, very positive on that. So who would have thought that would be the case? And it's the same with property, as we'll see in 1 or 2 slides later. So what's behind all that? So clearly QE and liquidity. Central banks around the world came in and just pumped the systems full of liquidity. It worked in 2009, 2008, 2009, and they've done it again, and it's worked now. It's created a whole load of liquidity, which is always helpful for asset markets, any asset markets. Okay, there's been huge government support. We know in the UK and everywhere else, furlough, lots of government spending, debt has gone through the roof, but that's fine. We're in an emergency situation right now, so that can be justified. Interest rates are at all-time lows, next to nothing. Very, very helpful for any asset price, stocks and property included. Tech stocks have gone through the roof. So as you can see from the chart here, Nasdaq is dominated by, or tech stocks are dominated by the Amazons and the Googles and the Microsoft and the Facebooks. So all of these guys have been huge beneficiaries of lockdown, right? So Amazon is the clear beneficiary of the high street being locked down. Netflix is the clear beneficiary of Cineworld and View almost collapsing. So for every loser in I guess the bricks and mortar world, there's been a winner in the tech world, and that's helped markets. Vaccines. So there are hopes about a vaccine, that we will get a vaccine at some point in 2021. That's helped the perception that we're going to bounce back economically and from an earnings growth point of view. And we've had a second wave. It's not as deadly as the first wave. Okay, I know deaths are increasing, and it's a really concerning point where deaths could quite easily take off, but we haven't had the same level of deaths yet. Okay, and I'd stress that word yet, because if that happens, we have an equivalent sort of death rate, then it's pretty bad for markets all around. But that's not happened yet. Okay, we wait and see, and hopefully that doesn't happen again. So they're the stock markets. Onto property post-COVID. So this is a nationwide data. I think Richard might have shown some of this data. So nationwide data is showing, strength. Again, September data was very, very strong, up 5% year on year. And UK house prices, as we see there, are at all-time highs on average across the UK. And again, who would have thought it? 6-7 months ago, who would have thought that we would be in this position, given all that was happening, back in February, March? So why has property been so strong? Well, interest rates are very, very, very important. Everybody talks about the furlough scheme and ending, and people talk about the economic recession. People talk about unemployment. But if you look at, again, looking at the evidence, and the Bank of England did a long-term survey not too long ago, and if you can dig it out, it's on the internet somewhere. They did a big economic survey about what are the drivers behind UK house prices, and the biggest driver by far are interest rates. Interest rates and I would say the availability of credit, which I guess they've lumped together. So, interest rates are hugely important, and the fact that they're at all-time lows, and the fact that UK house prices are all-time highs, that doesn't surprise me. And what I think investors have to distinguish between and really separate the idea that there's an economic recession from an asset price inflation. from an asset price recession, because the two things don't always go hand in hand. You can have, and right now is a clear example, you can have an economic recession, which we are clearly in, and at the same time you can have asset prices at all-time highs, and the link between the two is credit and interest rates. So we mentioned liquidity already. Government support and the stamp duty freeze has been really important for UK property. And supply and demand. Okay, so this is something that's not really talked about that much right now, but supply and demand was already a big issue for the UK property markets, before COVID even came around, and that whole supply-demand imbalance has just been exacerbated now. It's just got a lot worse. Okay, and I've got a couple of charts to show that. This is all about supply. This data comes from the Ministry of Housing in the UK, and it's showing what's been happening to UK housing construction. So the latest data we have is Q2, and construction activity, not surprisingly, was down 52% quarter on quarter and down 26% year on year. So big decline, clearly due to lockdowns and everything. But what that means is that for the 12 months, for the preceding 12 months, the run rate for UK housing supply is 147,000, and that's down from, I don't know, what was it previously, close to 200,000. And we know that the government has a target of 250 to 300,000 new homes needed per annum just to stand still, just to satisfy the demand that is out there. And if we're building half that rate, there is going to be pressure on housing prices, and ultimately any price, whether it's house prices, stock market prices, whether it's the price of bananas, bread, milk, whatever, is ultimately determined by supply and demand, right? Nothing else matters. So that's going to be a big problem for house prices going forward, this supply. Hopefully the supply works itself out, but it might be a while before we start going back to the sort of normal run rate. So just a couple of other data points here. I've talked about interest rates. So yeah, we see the long-term chart. Interest rates are at all-time lows, and inflation is next to nothing. Since this date, I know we've had a bit of a bounce back since this chart was published. So I think we're up to 0.5% now, but still very, very low levels. But one thing I want to say is, again, we need to separate between what the government is telling us about inflation and what the rate in reality is. Okay. Now, I always argue that the government, the state is the biggest debtor in the country, and it is. Okay, so it's in the state's interest to show a low rate of inflation, because that reduces pressure on interest rates to go up. Okay, so the CPI rate, or the inflation rate in general, has been manipulated by the government, statistically manipulated for years now, and I would say, and I've seen evidence to suggest that the real rate of inflation is probably more like 5-6%. So it's a lot higher than the government is telling us. Okay, so why is that important? It's important because if you're an investor, or if you've got cash sitting around, that's having a big impact on your cash. Okay, the real value of your cash. If you've got 100k sitting in the bank, that's being eroded by £5,000 or £6,000 every year. Okay, not only are you not making any investment gains, you are losing, in reality, 5 or 6% in terms of effective value. Okay, so that's really important to bear in mind. Here's something I saw the other day. Okay, so we have the official rate of inflation, which was, as we've seen, next to nothing. But we also have inflation expectations that the public think that the inflation's at. Okay, and I saw this headline the other day, which was interesting. So inflation expectations hit almost a 7-year high. Okay, this is published by Citi and YouGov. Okay, so the public believe that the 12-month inflation expectation is 3.2%. 10-year expectation is 3.6%. So clearly there is a differential between what the expectation is by the public, and that's based on what they're seeing, right? Remember, we as the public are out there buying goods and services on a daily basis. So this is what we're experiencing. And I still think it's 5 or 6% because when we think about expectations, we sometimes kind of are anchored by what the official rate is, right? So this is probably artificially reduced by what the government is telling us. So again, I always count on inflation being, 5, 6, 7%, which is really important to bear in mind if you're sitting in cash. Okay. Moving on to the investment landscape post-COVID. So where are we now, and where are we going to go? So liquidity is in abundance. I speak to a lot of investors on a daily basis, pension investors, SaaS investors, SIP investors. I speak to institutional investors, pension funds, family offices, individuals. And the one thing in common is people are fearful. People have got a shed load of capital sitting around in the bank doing nothing, right? And everyone thinks the same. Everyone is fearful about something that's going to happen. So, that's a very common feature, but if you think about it, that's positive for the markets, and arguably that's one of the main reasons why the markets have been strong. And I'll show you a couple of charts in terms of what I mean by that. Interest rates are very, very low. So in terms of investment options, investors don't have meaningful options really. What do you do with your cash? You're not earning much in the bank, so the other options are property, stock markets, bonds. Government bonds aren't earning much money. We've talked about cash and inflation. Underinvestment. This is what I mean by liquidity and underinvestment. This is a chart published by JP Morgan. And what this chart shows is looking at the big institutional investors out there. This is the percentage of equities they own as a percentage of their whole portfolio. So the whole portfolio will consist of bonds and cash and other investments. Okay, so equities are normally the riskiest part of anyone's diversified portfolio. So we have this chart goes back to 1999. Okay, and the amount of equity in people's portfolios is at relatively low levels. If you take out the extremes, which were the all-time high in 2000, just before the crash, and the kind of all-time low in 2008, 2009, we're sitting at pretty low levels. And this only goes back to sort of early 2020, and we're probably a lot lower here post-COVID, because I think this is a few months old, this chart. So what I'm trying to say here is that big institutional investors are sitting at relatively low, almost all-time low levels of equities in their portfolio, right? They're fearful. They're fearful about the virus, about the impending economic collapse, whatever. They're fearful about a lot of things, and this is reflected across the board in terms of all investors. Okay, this is something that's really interesting. This is a chart by Robert Shiller. He's a really famous economist, US economist. He's a Nobel Prize winning economist, actually. And he has a, what's it called? A CCI, I think it's the Confidence Crash Index or something along those lines. And he's been running this survey since, for about 20 years now, as you can see, right? So this is a survey asking investors what they believe to be the probability of a crash. So it's an inverse indicator. So if you think the probability of a crash is going to be less than 10%, right, you'd be bullish, okay? And the number of bullish people on this survey is at all-time lows. This survey just reached an all-time low, right, during the period that it's been run. Okay, and it's run by a very respected economist, and it's a great counter indicator, right? If you go back to 2008, 2009, just when the markets were about to take off, we were at similar levels, right? Everybody and their dog were bearish just after the huge crash we saw in 2008, 2009. Everybody was bearish, just like they are right now. Okay, so it's a pretty good indicator based on the historical performance of this. I'm not saying it's an effective indicator. I'm not saying go out and fill your boots with equities right now, because things are a little bit different now. Markets are more overvalued right now compared to 2008, 2009. Okay, so you can't draw perfect parallels with where we are before, but it just goes to show how bearish and how negative the whole world is right now, right? Everyone's expecting a crash along the lines of 1929 or 87, which is what this survey asks people. Okay, so really interesting there. And the final thing I would just leave you with is on this is a long-term chart going back to 1970 of the global. This is called the MSCI World Index. So it's global equities basically. Okay, so you look to see how it's done. And if you're an investor worried about an imminent crash, okay, just look at this chart and just think about this. If you go back to 1970 and if you look at all the peaks, right, if you were the unluckiest investor ever, and if all you ever did was invest at the peaks, every peak, and that's the only time you invested, you'd be sitting on pretty amazing gains right now, right? If you'd invested right at the peak of 2000, again right at the peak at 2007, again what was that, 2016, and you can go back. It's a long-term chart, so you don't see the ups and downs going back to the 70s, 80s. But if you'd done that, imagine, right? You'd be sitting on huge gains. So the point I'm trying to make is that even if you did happen to invest right at the peaks, and if you invested at this peak, the chances are at some point, based on the history of global markets, at some point you'll be making huge gains over the long term. So the point is about investing for the long term. If you're planning to retire in the next 12 months, that's different, okay? Because you need your nest egg to kind of generate an income or whatever. If you've got 10, 15, 20, 30, 40 years ahead of you, you shouldn't be so worried about timing the market. It's much more important to be in the markets, and that's what this chart shows you. The risk is not being in the markets rather than timing it wrong. Okay, and just finally circling back to that inflation argument I talked about earlier, it's far more risky to have your capital being eroded by inflation at a compound annual rate of 4, 5, 6%. That's far more risky than timing your investment entry point wrong. Okay, so that's the investment landscape. Right, so what do you do? What should be your investment strategy, or what are your investment strategy options? Again, this is not investment advice, so please don't take it as investment advice. These are some of the options that people can be thinking about, okay? So you might be one of those people, and there's a lot of them out there, who are expecting that dip or that correction or that crash, okay? What I can tell you is that the same people have been calling for that correction, and especially a lot of the gurus have been calling for that correction and that crash forever, certainly for the last 6 months, and a lot of people have been calling for a crash for years and years and years. Okay, so the risk with waiting for that correction or crash, it could be a good strategy, but that might not happen. You might not see that dip or that correction, or if it does come through, it could be short-lived. That's the risk of waiting for a dip. The other alternative is you can drip feed your money in. Okay, so you could be employing what's called pound cost averaging. So if you've got a pot of capital, you could very simply divide it into 5 parts, 10 parts, up to you, and just drip feed it into the markets at regular periods of time. Okay, so that could take away the risk of investing at the wrong time, but at least you're investing. And the third thing, which is what I'm doing a lot, for full transparency, I invest in property, in stock markets, and in secured loans. And for me, secured loans are a great way to kind of capture good returns of anywhere between 8 to 12%, if not more, with an element of capital protection. I'm not going to talk about, we haven't got time to talk about sort of how that works, but you've got insurance in terms of asset and collateral and security there. So that, for me, gives me the best of both worlds. But I'm not putting all my money into that. I'm retaining my sort of regular investing in equities and property, because I'm in it for the long term. My holding period is indefinite. It's forever, because I'm not just investing for me, I'm investing for future generations. So I'm not worried about what happens in the next 12 months. Okay, so I think I've covered everything there. Here are my contact details. Very happy to receive emails, questions if you need. I think we've got time for questions right now. Hopefully Richard as well. And this is a bit of a plug for my website. So if you want to register, get access to sort of regular insights and also a sort of interactive checklist, investment checklist, you can register at investlikeapro.co.uk. Hopefully we're in time, Richard.
Yeah, great. Good timing there. Okay, great presentation, Manish. Thank you. Good detail there. A lot of things for people to think about. So there we are. There's Manish's site. Okay, we've got 15-20 minutes before we close down on this webinar. Always finish at 9 o'clock. So you've got some evening ahead of you. So a few questions. So first question is from David Aston. And David's saying, what are the chances of the interest rate, Bank of England, I'm assuming, going negative? And what would be the implications from that, Manish, do you think?
Yeah, good question. I don't know. I don't know, but it's an option out there. It's an option for the Bank of England to do it. It's clearly unprecedented, not just for the UK, but for the world. I think Switzerland have done that. It's normally an option reserved for kind of deterring capital inflows. So Switzerland is a great sort of flight for safety. It's a safe haven for investors sometimes, and if a country doesn't want its exchange rate to be appreciating, that's a tool available for them. It's also a tool available for to deter people leaving money sitting around and not invested somewhere. So to be honest, I don't think it would make much difference whether the interest rate was it's zero now or if it's minus 0.5. I'm not sure if it would make much difference, but it's a tool. It's another policy tool available for the Bank of England, and from a sentiment point of view, it would show, if it ever needed to, if things got really bad, it would deploy that tool. I don't think it would right now, because hopefully the economy will recover next year. But if we had a really deadly second wave, it's another tool available for them. And look, the other impact it would have is it would be pretty negative for sterling, because it would send a strong message out there for investors. So you'd expect sterling to sell off as a result, and that has often been a positive for the FTSE 100 at least, and potentially for exports as well, for UK exports. So it's a reflationary measure.
Thanks, Manish. Hope that's clarified that question. So obviously, the FTSE was down a fair bit today. Well, you mentioned obviously with Nasdaq and the tech bubble, and what do they call them? The likes of Amazon and what have you, that have really outperformed. Is that a bubble that could burst? We've had some uncertainty there, but this huge rise, I think 74% Manish, I think you mentioned, in terms of the Nasdaq.
Yeah. It's been that's a big risk. It really is a big risk. A lot of these tech stocks are on the face of it overvalued. They're trading on huge price earnings multiples. One thing people should be aware of that, it's I wouldn't just use high valuations as a reason, to sell stocks. You need to have high valuations plus an event, and that would cause a huge sell-off. But high valuations alone aren't hardly ever are sufficient for a market collapse. And if you look at Amazon's been trading at huge valuations for years and years and years, and it keeps going. And the reason stocks can trade at huge valuations is because the market is expecting the earnings growth to be strong and accelerating. So if you think about a tech stock, it might be trading at 100 times earnings, but if its earnings are growing at are doubling every year, that means that 100 PE is actually 50 times PE next year and 25 times PE the year after. So it's all about, you have to you can't just look at valuations alone, but you've got to look at earnings growth as well. But look, they've been on a huge run. Valuations, price earnings, and all measures are very, very, very high. So it won't take much for them to sell off if there was to be an event. So that is clearly a big risk. Absolutely. I'm personally not buying any tech stocks, because I just think they are overvalued, and they could keep going though. That's the risk. So they could keep going for another 6 months, 12 months, 2 years, and you could be missing out on all of those gains, like Warren Buffett has missed out on all of those gains.
Okay, good comments there, Manish. Thanks. Okay, so we've got a question or a comment here from Aruna. It says, I've been reading about Robinhood broker in the US, where Joe Public has been investing their money from government handouts into the stock market, and that's contributing to the stock market's rise. Is there any truth in this?
Is there any truth in that? Well, I mean, look, there's been huge stimulus, right? There's been QE, there's been government stimulus. Yeah, look, a lot of that money is going to go into into financial assets, into real assets. In the UK, we've had the bounce back loans, right? And a lot of those, I'm sure, have gone into the UK property market. So, yeah, that's nothing new. It's going to happen. If people are getting their hands on free money or cheap money, that's going to go into the markets, absolutely. So I don't know the extent. I don't know if that is, sufficient to cause a collapse when that money dries up. It's hard to know, but yeah, look, it is going into the markets, yeah, for sure.
Right. Okay. Manish, can you just flick back a slide, because Julian Reed wants to know your email address. Put your contact details there, please.
Yeah, sure.
There you go. Right. Next question. It's slightly off tangent, but from a John Luckett, who's saying, "What's your view on the future of cryptocurrency?"
Whoa. Okay.
Yeah.
I don't invest in crypto. I fail to see I understand the logic of why it was set up. Okay. But let me go back one step. I generally, my rule of investing is to invest in assets which generate cash flow, and where that cash flow is growing, or there is a prospect for that cash flow to be growing. So given that rule, I would not invest in crypto or gold, because they don't generate cash flow for me, and you can't value an asset properly unless it has cash flow. Okay, so that's the first thing. But the second thing about crypto, and look, I'm not an expert on crypto, and there are probably people on this call who know more about crypto than I do. But crypto was set up, and certainly Bitcoin was set up, I think it was in 2008, 2009, because people were fed up with QE and fiat money and all the rest of it. And people were losing faith in fiat money, because you can print money, but you can't print crypto in theory. But what I don't understand is that logic kind of falls down because yes, you can't print more Bitcoin, but you can, invent new cryptocurrencies. So that whole idea of limited supply is, to me, gets thrown out the window because you've got unlimited types of cryptocurrencies on the market. So the two things don't square up for me. Yeah, but look, I don't invest in crypto, and so I can't really offer you an informed view on crypto, unfortunately.
Okay, Manish, thanks for that. We've got a number of questions here, so we need to whiz through these
Okay.
in 10 minutes. Okay, so quick thoughts on Vanguard as an investment vehicle. Obviously, it's a huge brand, Vanguard.
Yeah, I like Vanguard. It's it depends on what you mean, whether you invest in Vanguard's ETFs or invest through the Vanguard platform. If you invest through the Vanguard platform, you're limited to Vanguard ETFs, but you don't pay any platform fees. If you invest into Vanguard ETFs, they're low-cost tracker funds. I think they are the biggest, one of the biggest ETF providers out there. I really like them. I invest in Vanguard ETFs myself, and I really like, if somebody wants a really lazy way of investing, passive, lazy way, all the rebalancing's done for you, it's very well diversified, just go and buy the Vanguard Life Strategy Fund, or one of the life strategy funds, because there are a few different sort of variations. So yeah, that's something I really like, and I always recommend to my investors.
Okay, next question from Anil Patel. Would negative interest rates impact on property prices?
Yes, in theory, yes, because there's, as I mentioned earlier, there's a very strong linkage between interest rates and property prices in the UK and everywhere else. So, by the same logic, if interest rates went negative, that would, it may not translate into lower mortgage rates. I don't know. Carl might sort of have a better view on that than myself, but it's certainly going in a supportive direction for interest rates, for property prices. Sorry.
Okay, thanks for that one. We've got two questions on good old Brexit. What are your thoughts on that if there's a no deal? That's from Lee Huckstep. And then second one from Sheila. Again, Brexit, people seem to think we've done it already, but the reality only starts on the 1st of January, says Sheila. Thoughts on Brexit, Manish?
Yeah, I have no. Look, I think the balance of probability is that we will get a deal, because I just can't imagine, on top of COVID, I can't imagine Boris to go out there and just risk his future, the government's future, on just going out there and playing hardball and getting a no deal, or trying to risk a no deal. I just can't imagine that to happen. If it did happen, clearly that would be very negative for the UK stock market. I think it would be negative for the UK property market, although it's hard to tell, because if you have a no deal, sterling would just collapse, and historically when sterling's collapsed, foreign buyers come in and snap up UK property. So it's kind of hard to tell what's going to happen on that front. I think it's a very good question for stock markets. That the FTSE 100 has been a huge dog in comparison to other markets, and the major reason for that is because everyone out there, foreign investors, are just scared of Brexit. So they're going to wait for that to happen, and then they'll come in. So I think yeah, it will have a huge bearing. I think on a risk weighted basis, if you believe the no deal is not going to happen, then I think overall there's a lot of Brexit fear already priced into the markets, in the FTSE at least. And once that comes through, once that uncertainty is resolved, I think the FTSE will have a very strong run next year. Hopefully, fingers crossed. It's due a strong run.
Okay, thanks for that. Yeah, interesting comments about the FANGs, which you've already mentioned, the tech stocks in the US about being overvalued. Okay, we've got time for a few more. Let's try and get through them as quick as possible. So David Freen's saying, where now for bank lending rates, Manish? Up or down? Should we fix now or wait and do it later or whatever?
Whoa. I don't. Yeah. So I don't think bank base rates, the Bank of England rate, I don't think that's going to move, for a long time, up or down. I think, we're going to stay at these levels for a long time. So given that, what impact does it have on mortgage rates? Well, mortgage rates will kind of move on their own accord based on how risky the lenders believe the markets to be. So I don't think we're going to get a huge move. The short answer is I don't think we're going to get a huge move either way, honestly. So if it means you fix at a huge premium over variable rates, based on that, I would choose variable rates if there's a big gap. If there's not much of a gap, and if you don't think you're going to refinance for the period of time you're fixing at, if you don't think you're going to refinance, then yeah, I mean, go with the peace of mind. But I don't think rates are going to move much either way for a long time.
Okay, thanks for that one. Tom Maloney says, what do you think is a sensible percentage allocation of your capital across the various asset classes moving forward?
That's a very individual thing. That's really about your own personal circumstances, what your risk tolerances are, what your objectives are, what you want to achieve. So I can't really advise people on what they should be doing. For full disclosure, myself, I'm 40% in equities, 35-40% in property, and the balance 25% in secured loans.
Okay,
so that's not the same as what you should be at.
Yeah. Tom may well be 85 or 90, yeah, completely different circumstances depending on your age, and yeah, it's a tricky one to answer that one, Tom. But at least Manish has been honest enough and transparent enough to tell you and everyone else what he's personally into. Right. So question here from Ali Batu as we come towards the end of tonight's webinar is, what's the effect of quantitative easing on property prices? Because obviously they're pumping more money in, aren't they, Manish?
Yeah, QE is a very it's a major determinant of what happens to property prices. As I mentioned earlier, interest rates are a huge determinant, as is the availability of credit. So if by doing QE, that means that banks are lending more, have a higher sort of willingness and appetite to lend, that's hugely supportive for property markets. And the way QE works is that it injects money into the financial system, it lowers bond yields, and it kind of encourages banks to go out there and lend more, in theory, and it's worked. It's worked since 08, 09, and you can argue it's worked now. So QE has a big impact on property prices. Yeah.
Okay, last question, Manish, is really going to return to something that you mentioned that you are in terms of your own portfolio, and you mentioned that you do HMOs, you do single lets, and you're also into secured loans for developers. So really, this is a property related question. Well, I mean, what should people be thinking about given and it's going to be something we're going to cover in a webinar in the next 4 or 5 weeks in much more detail. But what should people be thinking out in property terms? Should they be thinking about HMOs? Should they be thinking about single lets? Or should they be thinking about investing more in development ahead, whether that be from secure loans or through taking equity stakes or whatever in development? What are your thoughts on the property scene?
Yeah, I think HMOs are. I mean, I'm involved in all three of those areas. I think, look, it depends on, again, it's one of those it depends answers, because it depends on the amount of effort you want to put in, depends on the amount of risk you want to generate, it depends on how much capital you've got as well. Secured loans give you hands-free 8 to 12% returns. I'm getting 8 to 12% returns with a lot of security behind them. You've got to choose the right loans with the right amount of security to make sure there's good security and safety there. So that's what I'm earning. On average about 10-11% across the portfolio. HMOs are variable. Buy-to-lets, your average rental yield across the property space right now, I guess, is about, let's say, 5%. If your capital growth is, I don't know, 0 to 5%, that gives you in total 10%. And then you can lever that up a little bit, but you've got a load of hassle. You've got to fix roofs and deal with tenants and all the rest of it, and you've got to deal with regulations and all that. So it depends on what you're after and what you want out of it, really. That's what it depends on. So that's how I would look at it. But I think they're all good assets.
Yeah. No. Great. Okay. Well, listen, that's we're pretty much at the end of tonight's webinar. Thank you, Manish, as always, and no doubt in the spring we'll ask Manish to come back and give us another update. As I say, the last one was 6 months ago. So that's I think you made a point about time in market, and I've just scribbled down that as when you said that, Manish. So I've always taken the view about being a long-term investor in the stock markets, and I know people trade. I've got a colleague who trades on a daily basis in the stock markets, and sometimes it do very well and sometimes not. But time in market, as you've shown with your statistics, is very important. So we've had some great comments here from lots of really positive comments, Manish, so that you know. Fiona, thank you. Sheila, thank you. Ali, thank you. David Aston said, thank you for asking a question. John, lots of positives there, Manish, just so that you know people appreciate your input here tonight. And there we are. So just for me to thank you, Robert Graver. Hi, Robert. Hope you're well. So it says thanks for a great webinar. And Colin Jowers, thank you, Colin. Great session. And thank you, Richard Woodstock. Brilliant. So that's it for tonight. Manish, thank you very much.
Thanks, Richard, and appreciate all the questions, everyone. Thank you.
Thank you. So there we are. Manish details on the screen. Contact him if you want further information. And thank you and good night.